So now we'll see the accounting of amortized cost method. Very important. And in case of financial asset also, there is a category called amortized cost. Whatever we are going to learn today, in case of liability, you just have to reverse it here as a financial asset. Okay. For all financial instrument, general rule is that it will be measured at fair value. And how do you compute fair value in case of financial liability? As per Ind AS 32, fair value of financial liability is proceed minus transaction cost. Underline. Proceed minus transaction cost means you have issued debentures of 10 lakh. 10,000 rupees is your issue expense. So fair value of liability will be 9,90,000. So you are going to record a liability at 9,90,000. Then some student will say, sir, my intermediate teacher has taught me like this. Intermediate. Bank account debit 10 lakh to debenture 10 lakh. Second entry, expense account debit 10,000 to bank account 10,000. Third entry, P&L account debit 10,000 to expense account 10,000. This is right if you are an intermediate candidate, if you are following accounting standards. But if you are following Ind AS, this is not right. Here you have to pass one entry, bank account debit 9,90,000, or you can pass two entries with same effect, to financial liability 9,90,000. So my journey will start from 990 only. Or suppose you want to pass two entries, so this will be 10 lakh, 10 lakh. Second entry will be financial liability to bank. How much did I finally receive in my pocket? 9,90,000. We have raised 9,90,000. Why are you writing 10 lakh? Is it right? Don't you think that's very funny? You have raised 9,90,000 and you are paying and you are showing 10 lakh. But there are some basic exception, simple exception, like for example, if the liability is short term in nature, then we do not use discounting. It should not be discounted. If something which is payable within 12 months, payable in less than 1 year, then such liabilities, for simplification, you do not discount them. You do not discount them. Is it right? We don't discount them. But suppose you have a zero coupon bond. Have you heard zero coupon bond? Zero coupon bond don't pay interest, but they are redeemed after some years. So suppose after 10 years, the holder will get 10,000. How much I will recognize today? If this information is given in the problem, then I'll take that information. But sometimes institute does not give you that, but they will say market rate of interest. Market rate of interest for similar bond with similar risk is 10%. So I will find the discounted value of this. That will give me the fair value of the zero coupon bond. Is it right? So sometime we'll have to use discounting technique. I hope all of you are familiar with discount rate, present value. Second is any difference on settlement will be transferred to profit and loss at the time of settlement. So if it is a short term instrument, don't discount it. Let us say you have a creditor, you have to pay 10,000 to him, but you said I'll pay only 9,800 and he agrees to it. So this 200 you will recognize as profit in P&L account. Any gain or loss here with respect to this short term financial liability will be transferred to P&L account. If it is a long term in nature, then it should be discounted. Long term means if you find it is more than 1 year, then we'll discount it. Now what about the discount rate? That depends on how the question is framed. Fair value is considered at discounted value. Hence, effective rate of interest method should be calculated for accounting purpose. Sir, how do I compute effective interest rate? Effective interest rate means IRR. Then you will ask me now how IRR is calculated. How IRR is calculated? I will tell you in the problem. Okay. Fair value is proceed minus transaction cost. And then for the purpose of calculating interest amount, we will not take coupon rate, we will take effective interest rate. We are going to recognize interest expense not based on coupon rate. Coupon is only a repayment of the amount agreed. What we are actually incur is the effective interest rate. So that effective interest rate is calculated, and based on that effective interest rate, interest expense is recognized. For your understanding, briefly I have written effective interest rate means that discount rate at which fair value is equal to present value of contractual obligation, that is IRR, that is PV of cash outflow is equal to PV of cash inflow. Have you studied IRR like this? Yes. So today we'll test your knowledge of IRR. So financial liability measured at amortized cost will be initially recorded at proceeds less transaction cost. Subsequent accounting will be using effective interest rate method. If it is a amortized cost financial liability, important thing, they are not subsequently remeasured. It is like cost model only, but there are adjustments made because the financial liability may be issued at a discount or at a premium, or may be redeemed at discount or at premium, or there may be some transaction cost involved. So it's not always that it is equal to face value at the time of issue and face value on redemption. Because of that, the rate of return can be different from coupon rate, and that is why we use effective interest rate. And this method of accounting is called amortized cost method. They are not fair valued. They are not fair valued. Now I will give you a list of journal entries and you will have a cultural shock now. I told you this standard will change a lot of concepts that you have learned so far in your life. First is, at the inception, I will record bank account debit to financial liability. Amount will be equal to proceed minus transaction cost. Proceed minus transaction cost. So this is first cultural shock, because from 11th standard till yesterday, expense was transferred to P&L account. Now you are adjusting it against financial liability. Second cultural shock is how much interest you are going to charge in P&L account. Understand, suppose face value is 10 lakh, coupon rate is 10%, but effective interest rate is 11%, and fair value is, let us say, 9 lakh, 90,000. Fair value means this amount. My question is, how much interest expense will be recognized in profit and loss account? If you are an intermediate student, you will say 10% of 10 lakh, 1 lakh. Inter student will say, final student who has learned Ind AS, he will say 11% of 9,90,000. So that is how much? He will record 1,08,000 as expense in P&L account, but actual payment is 1 lakh. Actual payment is 1 lakh. 1 lakh is treated as a repayment of obligation. 1 lakh is repayment. What is my obligation? I have committed to debenture holder, dear debenture holder, I have an obligation to pay you 1 lakh, 1 lakh, 1 lakh in the first 4 years and 1 lakh plus 10 lakh in the 5th year. This is my obligation to pay you. So that is, I am going to adjust against my financial liability because I have an obligation to pay. But to my P&L account, I will recognize expense which is my effective cost. Which is my effective cost. Is it right? What I have effectively incurred. I have raised 9,90,000 and my effective interest rate is coming to 11%. So don't you think effectively I am paying 11% of 9,90,000 in the first year? This is why the standard focuses on effective interest rather than coupon. Coupon is just a repayment of your promise to pay cash. That is not your cost. That is not your cost. For example, I'll give you an extreme example so that you will be convinced. Suppose you have issued 0 coupon bond. Okay, for 6,000 rupees today, and you have to pay after 5 years 10,000 rupees. You are not going to pay any interest over the next 5 years, only repayment. Now if you are an intermediate student, what will you do in the first year? Where will you record the interest? Inter teacher never told me to record interest unless we pay. I will not record interest in second year, third year, fourth year, fifth year. And in the 5th year, we are going to write an entry 0 coupon bond account debit 6,000 because that never changed in my book. P&L account debit 4,000 to bank. Now visualize how much damaging effect it will have on the P&L account. You are using the money for 5 years. You never charge the cost of funds to your P&L account. And now you are charging entire amount in the last year. Don't you think it is wrong? Another example to prove that your previous accounting were wrong. There are companies which pay interest like this. First year 2%, second year maybe 4%, third year maybe 6%, fourth year 8%, fifth year they may pay 12%. They may say the investor that this is how we are going to pay you interest every year. Does it mean you are going to charge say 20,000 in first year, 40,000 in second year, 60,000, 80,000? Year on year basis, how much damaging effect it will have on P&L account? You are using the same 10 lakh rupees in all the 5 years, but first year gets a hit of 20,000. The 5th year is getting a hit of 1,20,000. Oh my God. So what will you do? Go to intermediate class. Ask for refund. That's because they have taught you wrong. So we are going to pass an entry, borrowing cost to financial liability, interest charge, it will be equal to, it is based on EIR. The amount will be equal to opening financial liability multiplied by EIR. opening financial liability multiplied by effective interest rate, and this borrowing cost will be either charged to P&L account or will be capitalized if Ind AS 23 permits. If Ind AS 23 permits. If Ind AS 23 permits. Some books write charge to P&L account. Generally you are right. But if the loan is taken for acquiring, constructing, purchasing a qualifying asset, then that interest is capitalized. Again, one important thing, till intermediate stage you are capitalizing the coupon amount. OMG. Now in final you will not capitalize the coupon amount, you will capitalize the effective interest cost. So Ind AS 23 also will say interest to be calculated as per effective interest rate method as discussed in standards on financial instrument. Is it right? Because some students usually ask, why don't you take Ind AS 23 earlier? It is an easy chapter, we have studied it also. The problem is, the whole Ind AS 23 requires you to compute interest using EIR, and this concept requires lot of explanation. Without that you will not be convinced. So I have kept that Ind AS 23 for later part, because once you are familiar with this accounting and you are convinced, then you will find Ind AS 23 is okay. Otherwise it was very difficult to convey the message before taking financial instrument standard. So you will remember this calculation, and when you make any payment to the liability, you are basically fulfilling your commitment to pay. Financial liability to bank, or in case variable number of shares are to be issued, financial liability to equity variable, because variable number of equity share will make the instrument a liability. So this is what entry you will pass. Borrowing cost usually will be transferred to P&L account. Write down borrowing cost usually will be transferred to P&L account. It's not a general statement, it is subject to Ind AS 23. Financial liability will be classified in balance sheet either as current or non-current. That is okay, depending upon how much portion is payable within 12 months and how much portion is payable beyond 12 months. Now we are going to solve some basic fundamental questions. You will find some questions are beyond your study material. The reason being, study material suddenly changes the gear from 1 to 6. Study material teaches you cycle, but then gives you not truck, Sukhoi, and say you drive now. So person who was driving cycle, suddenly he has to drive that Sukhoi, and you know what happens to Sukhoi in India? What happens? MiG, Sukhoi, what happens to them? Sometimes they meet with accident. In the newspaper you will find this Sukhoi has crashed, this MiG has crashed, and they blame Russia for giving a wrong technology. The problem is not with that, the problem is with the training. Suddenly the pilot's level increases so much, he is not able to handle it. Okay. Same thing happens when you enter into final from intermediate. Suddenly you will find there is a jump in the learning, the conceptual base. And I am sure you must have realized the financial reporting subject, what you are learning now and what you have learned earlier, there is no connection.
Not the same subject.
Doesn't look like we are learning the same subject only. Question number 19. That is why I have inserted some basic question in between, so that the process will be smooth. The whole chapter will be over in next 2-3 days and you will not realize I have covered financial instrument. Some student will guide you, sir, leave these two topics as an option. Ind AS 109, very difficult, very complex. It's not. A Limited issued 9% debenture of rupees 10 lakh for rupees on 1/4/21. Debenture will be settled by issue of own share. Now, if they are saying debenture will be settled by issuing own share, so we are in element number 3. Do you remember? Element number 3 says contractual obligation, non-derivative, settled in own equity. But you have to ensure that number of equity is variable. Let us read till the last line to understand. First, second, third condition got satisfied. Date of conversion is 31st March. Number of share to be converted will be based on fair value of the equity instrument on 31st March. So, condition number 4 also satisfied, which means number of share to be issued are variable. So, this will be a financial liability. This will be a financial liability. Assume fair value on 31st March as 16 rupees. So, 10 lakh divided by 16, how many shares will be issued? 62,500 shares will be issued. Face value is 16, into 10 will be transferred to share capital, into 6 will be transferred to securities premium on maturity. Is it right? And prepare ledger account. Now my question is, what is the fair value today? Answer quickly. What is fair value today? Proceed minus transaction cost. Proceed is 10 lakh, transaction cost is not there. So fair value will be 10 lakh. Redemption is also 10 lakh. So if the issue price is 10 lakh, redemption is also 10 lakh, coupon rate and IRR will be same. Coupon rate and IRR will be same. Keep that in mind. That is a shortcut to understand. If you have studied financial management, especially bond valuation chapter, Mr. Hari is right, 10 lakh rupees fair value. I am very happy you have replied today. So let us come to the answer. First we need to check, do we have a financial liability? Yes, there are two obligations in this question actually. One obligation is to pay 90,000 rupees every year. That is also my obligation. My second obligation is there any obligation to exchange potential under unfavorable condition? No. Is there any obligation to settle in own equity instrument which will be variable in nature and the obligation is non-derivative? The answer is yes. So there will be variable number of share. Therefore, this is a pure liability. Pure liability means coupon is also liability, redemption is also liability. Coupon is a fixed amount of cash to be paid every year. Redemption is a variable number of share to be issued against a non-derivative contract. Is it right? So both principal and coupon are liability. So they are called pure financial liability. Now I am going to explain with the help of this line, this timeline also. You have issued debenture for 10 lakh. You have an obligation to pay this 90. Coupon payment is financial liability. Redemption value in variable number of share is also financial liability, and therefore this instrument will be treated as financial liability. Is it now, what is the classification I need to use? Is it a derivative instrument? No. Is it a financial guarantee or loan guarantee? Is it consideration, contingent consideration? No. And will the company apply accounting mismatch? That I don't know, because data is not sufficient. So we will assume that fourth condition, we are not going to call it as FVTPL. On your own, don't assume anything. So you will say it will be amortized cost instrument. Initially measured at fair value. Fair value is proceed minus transaction cost, which is 10 lakh. Subsequently it will not be remeasured. So this question is, be happy, like your intermediate only. Okay, because coupon rate, EIR are same. One more note write down which they have not written. One more note write down, as the coupon rate, as the issue price is rupees 10 lakh. Write one more note, as the issue price is rupees 10 lakh and redemption value is also rupees 10 lakh, and redemption value is also rupees 10 lakh. EIR is equal to coupon rate. EIR is equal to coupon rate. EIR is equal to coupon rate. Is it right? Very good. That is 9%. EIR is equal to coupon rate is equal to 9%. Next question I will ask you to take calculate EIR. To start with, easy problem. Is it right? That is how the student's confidence will increase. So what is my accounting? Enjoy. This is like your intermediate debenture accounting. Buy bank account or your foundation course wherever you have studied. 1st April 2021, buy bank account, write down 10 lakh. 31st March 2022, first you will create interest accrued liability. 31st March 22, credit side, buy interest 9% of 10 lakh, 90,000, and then you make the first contractual payment, that is obligation to pay 90,000 rupees at the end of year 1 to bank. Contractual obligation paid. You have a 3 contractual obligation for coupon and 1 contractual obligation for interest. To balance carried down 10 lakh. Is right? Total 10 lakh 90,000. Next year 1/4/2022, buy balance brought down 10 lakh. Same buy interest 90,000, to bank 90,000, to balance carried down 10 lakh total. Such an easy question. This will not be asked in your exam. This is just to begin this topic. Then buy balance brought down 10 lakh, buy interest 90,000, to bank. Wait, now it is the redemption date. This is the redemption date. Don't write balance carried down. You have to issue equity share equal to rupees 10 lakh. Number will depend on market value of share on that date. Market value is 16. Amount to be paid 10 lakh. Divide by 16 into 10 rupees face value. Into 10 rupees face value. 6,25,000. All calculation must be shown. Okay, all calculation must be shown, and the remaining amount write to securities premium 3 lakh. The standard does not use the term security premium. Remember, standard says you can transfer it to other equity. Standard does not use any specific name for any reserve. Okay, but Companies Act says any amount received over and above face value while issuing shares will be credited to an account called securities premium. So that is because of Companies Act. We have taken to securities premium. If you ask me, can I take to P&L account the extra amount? The answer is no, because you are issuing own share. Companies Act will say extra amount collected is securities premium. Question number 20, date of issue 1/4/2021. 9% debenture 10 lakh, transaction cost. Oh, so now you don't apply intermediate intelligence. My fair value will be proceed minus transaction cost. redeemable by conversion into equity share of own company on 31st March based on fair value of share. So you have two obligations. One obligation is to pay coupon, a fixed cash payment you have to pay for 3 times, which is 5%, how much? 9%. 90,000, 90,000, 90. This is also obligation. And redemption premium is 5%. So 10,50,000 you have to pay on maturity in variable number of share. Obligation to pay in variable number of equity share is also a liability. So coupon is a liability, redemption is a liability, so it's a pure financial liability. It is possible coupon may be financial liability, but redemption may be a fixed number of share. So redemption will become equity. Then it will become a compound instrument. It will become, because then it has got features of equity and liability, right? Compound instrument towards the end of this chapter. Assume fair value on 31st March 2024 is 16 rupees per share, but this time the number of share to be issued will be 10,15,000 divided by 16. How much is that? 65,625. Okay. So in this question there is one important thing which is missing. What is missing? IRR is missing. I cannot assume IRR is 9% because my cash flows are like this. In year 0 we get 9,50,000. Year 1 we have to pay 90,000, 90,000, and in the last year I have to pay 90,000 plus 10,50,000, which is how much? 11,40,000. So redemption is also not at par. Issue is also not at par. So this question will have a different IRR. If you have studied IRR, you can solve it. If you have studied bond valuation chapter, we used to calculate YTM, yield to maturity. Yield to maturity is IRR, is EIR, whatever you want to call it. Is it right? So first we will do some mental exercise, not required in the exam. First, when you read a problem, check if it is a financial liability. Financial liability always have a contractual obligation. Identify contractual obligation in this question. There are two contractual obligations. One is to pay 90,000 per annum, which is a fixed cash to be paid, so it is a financial liability. Second is to issue own share, but the number of own share to be issued is variable, so that portion is also a financial liability. Now next is the classification. It cannot be classified as FVTPL because it does not fit into one of those four or any of those four requirement for FVTPL. So we will call it as amortized cost instrument. Third is, what is the initial recognition amount? Fair value. Fair value is equal to proceed minus transaction cost. And how it will be subsequently measured? It will not be fair valued. Will it subsequently be fair valued? No. You can just add here, it will be accounted using EIR. It will be accounted using EIR. So we'll see now the application. Very good question for beginner understanding the concept of amortized cost accounting. And had it been a financial asset, you will do the reverse. So step number 5 written in the book. In the exam you start from here, okay, or you can just briefly write down it is a financial liability and it will be accounted at amortized cost. Start. First we'll write fair value. Fair value means net proceed received. Proceed received 10 lakh minus transaction cost 50,000, and then the net proceed is 9 lakh. Even though I tell 5-10 times that we will record directly 950, still some student ask me this question, sir, you have not recorded that 50,000. Sir, you have not transferred 50,000 to P&L account. Where it has gone? It has gone here only. Is it right? And the effect of that is that your effective interest rate goes up. If you issue bond at discount or at lower price, EIR goes up. So somewhere this 50,000 gets adjusted in the future higher EIR. Understood? So only student with knowledge of little finance can understand this part. Somewhere this is getting accounted, but not immediately. It is spread over the life of the bond in the form of higher effective interest rate. Now write down journal entry on initial recognition, right hand side, debit credit. On 1st April, we are directly going to record bank account debit 950. There is no need to pass two entries. If you want to pass two entries, bank to 9% debenture 10 lakh, 10 lakh, and the next entry will be 9% debenture 50,000 to bank, not P&L account. Being liability recognized. Note, I have written notes in this chapter at several places. Even if you get bored, it's okay. Transaction cost will be deducted from proceed received in case of amortized cost category. Transaction cost is not charged to P&L account if the financial liability is amortized cost category. Now just keep in mind, if the financial liability is FVTPL, then transaction cost is charged to P&L account. Then transaction cost is charged to P&L account, because then it is fair value through P&L account. So in any case, if I do fair value, the difference will come. Difference will go to P&L account only. And these are for short term. These are for short term. Generally, FVTPL means you don't have long term generally interest in that particular item. So they say that transaction cost you transfer to P&L account. Now my next task would be to find out the effective interest rate, otherwise you can't prepare ledger. Okay. How do you compute EIR? You have to apply a method in mathematics called interpolation, where you will assume a rate of discount as EIR, calculate NPV at that rate. If it is 0, that is your answer. If it is not 0, then you have to increase the rate if NPV is positive, or decrease the rate if NPV is negative. That is how usually we do. If you have learned any other method, please go ahead with your method. Final answer must be same. If not same, close to same. Two students may get slightly different answer, because this method is not 100% accurate. It is approximately right, but not 100% accurate method. Okay. Classroom formula is not 100% accurate formula, but acceptable for exam purpose. Accurate formula you can get only on the Excel, or in a scientific calculator, or financial calculator. Not allowed in the exam, any of the three. Right. Year 0. First we'll make a list of cash flow. Then the student will ask me, sir, why did you take 12%? Why not 6%? Already their coupon payment is 9%. Am I right? You are redeeming at a 5% premium. You are issuing at, you are not issuing, but you can say there are 50,000 transaction cost. On one hand you are receiving 50,000 less, you are paying 50,000 more. 1 lakh rupees extra you are paying over 3 years. So that is going to increase your cost. Your cost is certainly going to be more than 9%. You can start with 10 if you want.
You have told the trick, how to guess how much to start with.
For that trick we require that annuity factor table. Okay, approximately like 9% in any case you are paying, and you are paying 1 lakh rupees more. 1 lakh more over how many years? 3 years. So that is 33,333 you are paying every year more. And that suppose I divide by roughly 10 lakh rupees. So that is 3.33%. So if I roughly add 3.33, roughly, all these are rough calculation, because time value of money is also involved. This 1 lakh I have directly taken, but 50,000 is now and 50,000 is after 3 years. So roughly I got an idea that it will be somewhere around 12, 13, 14%. That is how I mentally do this exercise. But there is no harm, you can take 10% also. Okay, you can take 10% also. Start year 0. Year 0, I don't teach that, unnecessary student get confused. Take year 1, 90,000. 190,000, take 12% factor and multiply by 90,000 for year 1, 80,357. Take 13% and try. 79,646. Year 2, try year 2. Try year 2. Everybody please try present value. Now somebody is asking, suppose how to calculate present value. 90,000 divided by 1.12, and if it is a second year, press equal to twice. Third year also 90,000 divided by 1.12 to the power 3 divided by, press equal to 3 times, you will get it. What about last year? 62,375, and last year is 10,50,000. Last year is 10,50,000. Last year is 10,50,000. 747,369 is right. Next one. Next one. 727,703. Now take total at 12%, including this figure minus 9,50,000. Please confirm. I have done the calculation myself, but I am not sure 100% if it is right, and sometimes there can be a typing mistake also. So will you please check? Is it 13,533? Last column. Last column, please reply. Last column, please reply. 9794. No problem. 1 rupee difference is okay. 9793 or 9794. One is positive, one is negative, which means we have answer between 12 and 13. I need to get an NPV of 0. Now we'll apply the interpolation formula. EIR is equal to our lower discount rate is 12 plus NPV at lower discount rate. NPV at lower discount rate 13,533. In the denominator we'll take the difference between these two figures. Difference means if one is positive, one is negative, difference will be the sum of the two. Difference will be sum of the two. 13,533 minus 9794, which means it will become plus here. I hope you know that. Today is not the time to teach IRR. Please cooperate. EIR is 12.58. You can write 12.6. Please write same answer which I have written, so that you can match every figure in the ledger. 12.58 is 100% right, I agree, but just to match with the classroom, everybody write 12.6, unless it is a huge difference. Is it a huge difference? Are you getting 14 point something? No. 12.6 is, everybody go ahead with the same. Otherwise difficult to check everybody's notebook. Now we'll prepare ledger. Now you'll understand the standard, how effective interest rate is useful. How much funds did we raise? 9,50,000. And what is my effective interest rate? So I will compute my financial cost, my interest cost, my cost of using the fund at 12.6%. My cost of funding is 12.6, not 9%. Am I right? Effective cost of funding is 12.6. So my P&L account should reflect that. My P&L account should reflect that. So now write down to bank, and on the debit side what we are writing is our obligation which I have to pay. That is not my cost. I may not pay him interest for 2 years. I will pay him directly after 3 years. Does it mean I will not book the expense? I have to book the expense, which should be effectively what I have borrowed. 90,000. To balance carried down. 979,700. So if you follow the figures which I have taken, easy for me to check your answer. Buy balance brought down. If you are not sure, use a pencil. Now what about second year finance cost? It will be opening balance into effective rate again. It will keep changing. It will keep changing. First you do it, I'll again explain. Anybody? 123,442. Very good, very good. Next line, debit side, to bank. 90,000. To balance carried down. Come on. Don't remove the number from calculator. Okay. Yes, 10,13,142. Learn to use your calculator in such a manner that you don't have to remove it. Still you can get the next number. 1,423. What is your interest? Wait. Don't write, just tell me. Interest, how much did you get? 127,656. Student is saying 127,656. Wait. Last year I have to pay 10,50,000 plus I think interest also 90. So how much is 1050 plus 90? Because after paying these two figure, my balance should become 0. So last year usually what we do, we write interest as a balancing figure. So just take on your calculator first 11,40,000, then minus opening balance 10,13,142, 126,858. So it may be slightly different, possible, because your IRR is a rounded off figure. First is your IRR is not a 100% accurate number. Okay, it was rounded off in 1 digit after decimal. So some difference will come, which is okay, because the amount is big amount, 10 lakh something. 0.02 will make a difference of 200 rupees. And on the debit side, first you pay the interest to bank, coupon, we'll call it coupon. Pay the coupon 90,000. This is called coupon. Issue share capital. To share capital, take on calculator 10,50,000 divide by 16 rupees into 10 face value. 656,250 balance securities premium. This standard does not tell you have to transfer to securities premium. Companies Act tells you that when you are issuing own equity share, and you get something more than face value, that additional amount received is transferred to securities premium. So to securities premium 393,750. $393,750. That is how the ledger will be prepared. Now you pay attention what is happening. First year my opening balance was 950 plus interest accrued 1,19,700. But how much interest did we pay? 90,000 we paid. Which means I further borrowed from the investor 119,700 minus 90,000. I had to, my liability increased by 119,700, but I paid only
90,000.
So I had a further increase in liability, and that is why next year when you compute the interest, it is on this amount, which is not only this 950 but a further increase in liability of 29,700. Right? If you are an intermediate candidate, your interest would be equal on the 3 years. Is it right? But your first year will also include that 50,000 rupees of expense. So first in intermediate you would have recognized 1,40,000 in the first year as expense, 50 plus 90. Then you would have recognized 90, and last year you would have further recognized an expense of, because you are paying more, so that 50,000 liability you have to first increase by 50,000. So that is my total is 1,40,000 here. In final what you are doing, you are recognizing 119,700 plus 123,442 plus 126,858. Can you please tell me the total, and you will find a magic happening now. Total expense recognized under Ind AS will be 3,70,000. Take this total 140 plus 90 plus 140, 370. Then what is the difference? Difference is tremendous. First year gets a hit of 1,40,000, whereas we get a hit of 119,700. Second year there is a low hit on the P&L account, whereas here we have little higher because my liability is increasing slightly. As I said, we have borrowed 29,700 more from that party. So next year my liability should also be, or expense should be slightly higher. Same logic applies in the third year also. So in old system what was happening, sometime you have a huge impact, sometime zero impact, no impact. Over 3 year effect is same, year wise effect is changing, and that is very important in financial reporting, because if you charge such a big amount here, maybe this year profit will be low. In classroom we are taking small numbers for understanding, 10 lakh, 20 lakh. Practically the loans are issued for 500 crore, 6,000 crore, and then it will hit also by some 100, 200 crore in P&L account. Is it right? Next year suddenly again the profit jumps, shareholder will rush to that company. Again third year it goes down, and they don't understand that this is because of the accounting, not because of the performance or efficiency. This or this does not represent any efficiency or performance, but they will affect your profit. Hence this is more logical, more fund you use, more expense you charge, right? And it is smoothened also. Imagine the problem that can happen in a zero coupon bond. You will not charge interest for 3 years, and suddenly last year you will charge 4 lakh rupees or big amount. So that can impact the answer. Some companies use teaser interest method. low interest in the first few year and then ballooning interest in the last few year. Now those company also will have same impact on the profitability. Coupon rate is just an obligation we are committing and paying. What I should charge is the effective cost of funding, and that is what happens when you use effective interest rate method. Is it right? Are you convinced?
Yes, sir.
Hello CA final student friends, we have come out with CA final FR regular video lecture in English language. You can purchase from our website vino.in. Along with the class notes, you will also be provided with summary chart and MCQ book. The price is only rupees 5,999. You can purchase from our website. You will get 5-year validity also. So this is a very good opportunity to learn FR conceptually in detail. From our website you can purchase at 5,999 vino.in. Thank you very much.